Okay, guys, so hopefully for revenue growth, you have something that looks like this. I removed the step equation because it's all hard-coded now to kind of reflect management's guidance. So I put in 3.5, 5.5, 6, 5, and 4.8, and that got us roughly to where management was guiding to. We finished 2018 with 2.8 billion. I did actually a few other things to kind of get close, and let me just kind of go through them quickly. So one of the disclosures here, right below the summary of core projections, is also the reconciliation from GAAP to non-GAAP operating income. So the forecasts for operating income were also on a GAAP basis were also provided: 539, 623, 712, 786, 844. And so I tried to come pretty close to that by really tweaking the gross profit, R&D margin, and SG&A margin projections. There's no way to get perfect unless you're sort of hard coding this, and I really didn't want to do that. So what I ended up doing is, rather than just saying, oh, gross profit is going to be 73%, I made gross profit margin a little bit higher by taking the average of the last 3 years. And I used a step function to sort of incrementally make that better and better, which got the operating profit higher and higher. With R&D margin, I also took the average and kept that flat. Okay. Remember, before I was just sort of setting it equal to the prior year. So I'm using another convention which happens to kind of get me more in line with management guidance. I'm sort of working indirectly to get to what management's projections are, so I can maintain these as my drivers as opposed to absolutely hard coding. The other thing that I did is I used the average for SG&A margin, and then I used a step function that shows that things are improving on the SG&A side as well. So I made that a -1% step function. Last but not least, for stock-based compensation, I made it 9.3%. I just hard-coded it and had a 0.25 reduction every year, and that got me pretty close to the forecast that management is giving of 162 through 158. One final thing that I included is, notice they're also telling you that, unlike our original assumption, which that severance and restructuring charges are going to be 0 going forward, they've actually identified what they're going to be: 16,5,500. So I actually just put that in there, and I included a footnote for where that's coming from. Anytime you're sort of hard coding forecasts, you want to source where that's coming from. Okay, and so the net result is that our operating forecasts and our revenue forecasts are pretty much in line with what management is saying they think is going to happen, which means that we're building a model that reflects the expectations we're being bandied about at the time. Certainly, management expectations are not the only expectations, and a financial sponsor doesn't necessarily have to believe what management is saying, and that sort of creates the rationale for creating scenarios around these. And those of you who went through our Apple case study know very well how you go about building scenarios. We're going to bake in some scenarios that show upside and downside towards the end of the course, just so you can see how that affects your returns. Obviously, if they don't achieve these goals, they're not going to get the IRR. And when I say they, I mean Golden Gate and Bain. They're not going to get the IRRs that they expect. So at this point, give this a shot yourself, and when you're ready, let's move on to the next video. Just make sure that you've got all these forecasts the same as we have in our model, so that your numbers match the numbers in the model that we're working through in our video.